first, let's break down today's action with our market panel, Tracy McMillion of Wells Fargo Investment Institute and Kevin Gordon of Charles Schwab. Great to have you both here. Kevin, I'm going to kick it off with you. We have a mixed picture here for major averages on this Friday afternoon. However, everything's finishing the week higher. We did get a record close from the Dow. What do you buy into now, especially if you have a Fed that has finally pivoted into this easing cycle?
Well, I think what's interesting is that, all the talk this week is how the Fed has taken a different approach relative to prior cycles where they start with a 50 basis point rate cut, which in and of itself might start to signal or at least look and appear like it signals panic. But of course, you look at an array of economic data, certainly not the case. So I think you have to sort of look at where we're at in economic terms, which is still pretty solid. And that sort of is consistent with a market that already looks relatively strong heading into it. I mean, as we were coming out of the Fed decision yesterday, you had 80% of members in the S&P 500 above their 200-day moving average. That breadth picture alone is much stronger than what you saw in the prior two cycles that started with 50 basis point cuts being in 2007 and 2001. So I think the underlying breadth statistics within large caps in particular, to some extent down the cap spectrum, because you have started to see, more of an improvement in the reaction in the Russell. I think that should be taken into account more so than a 50 basis point cut itself being some sort of negative economic signal.
And certainly small caps are in focus as this catch-up trade plays out right now, and we do start to see some technical levels. Tracy, want to get your thoughts on what we've heard, because we had some Fed speak today, including Governor Waller on CNBC. Take a listen.
The data starts coming in soft and continues to come in soft. I would be much more willing to be aggressive on rate cuts to get inflation closer to our target of 2%.
This was interesting because he really broke down, Tracy, how they've been calculating inflation and presented this thesis that perhaps it is trending softer than the data is actually showing right now, and that if that's the case, he'd be open potentially to more jumbo-sized cuts to basically play catch-up. Your thoughts?
Yeah, we think that the Fed actually was playing catch up yesterday or this week when they cut by 50 basis points, because we think that they actually probably should have started in July with 25 basis points and then had another rate cut here in September of 25 basis points, and then they could have continued on through the rest of this year with the 25 basis points rather than going so strong right out of the gate. But what Waller was referring to is that the PCE, which is the Fed's preferred method of measuring inflation, is now at 1.7% on average for the last 3 months. It started the year really strong, but it has come down pretty significantly. So if they continue to see inflation trending down like that, they're probably going to continue to come in with these higher than expected rate cuts. That's not our forecast. We think that inflation is going to continue to trend down, but probably not quite as rapidly, and that we'll see another 50 basis points in cuts in total for this year. So probably 25 in November, 25 in December.
Okay. So, Kevin, is the S&P 500 now, though, priced for perfection with the overall multiple being where it is? Do earnings just have to continue to be that good? And if so, do you need to look at either smaller stocks or fixed income or somewhere else to feel good about where you're putting money to work?
I mean, I think well, in terms of price, if you want to equate price to perfection being priced for some sort of soft landing, you could argue we're sort of living the soft landing now. With the trajectory of inflation, certainly, yes, you've seen some softness in labor, but the rise in the unemployment rate is not yet corroborated by some sort of massive decline in GDP or, an uptick in claims. So I think you're sort of priced for it and priced for perfection in that sense now, yes. It tends to be the case, though, when you look at the start of a cutting cycle. It's harder to determine what the trend is for the market in terms of what it's telling you for recession versus non-recession. So I think you sort of have to let the data come in and sort of tell us where we're at and where the cycle's going. And in particular, for this unique cycle, it's a little bit harder, admittedly, to do that. On the small cap angle, somewhat ironically or maybe counterintuitively, small caps really outperform large caps to a significant degree after a cutting cycle happens in an instance of recession. Because you think about, you go through that really large reset and washout for both the economy and the market. That's when you have, the companies that are more sort of leveraged to the economy and benefit from after an aggressive rate cutting cycle takes place. that's when you start to see small caps outperform meaningfully. So I think actually this environment where we're sort of, muddling through in a growth sense, not going into recession, not full-on boom expansion, it's probably not the best environment for small caps, but I do think that the prospect of lower rates, the fact that they're now actually coming down, which matters a lot more for small businesses, is, ultimately probably stimulus in the future, more so, taking away the restrictiveness now.